SCHD is up roughly 12% year to date, and a massive part of that story is energy. Crude oil is one of the most explosive stories in the market right now. As of this filming this afternoon, WTI crude is sitting at around $90 a barrel. Energy has pushed to over 20% of SCHD's total portfolio since last year's Reconstitution. That bet has paid off beautifully, and SCHD is about to potentially cut that energy exposure nearly in half, right as energy is skyrocketing. So is that a problem, or is it actually the point? Stick with me. Last year's Reconstitution made a bold move. Energy jumped from 12.3% all the way up to over 20% of the portfolio in a single Reconstitution. At the time, that made a lot of investors nervous, including me. Energy had been volatile and frustrating for dividend investors for years. It felt like a risky bet, but it turned out to be remarkably well timed. The magnificent seven giants that carried the market for the last 3 years are stumbling in 2026. SCHD has almost zero tech exposure. What was once seen as a weakness is now its biggest strength. Energy has been a core driver of SCHD's outperformance to start 2026. The system worked, so naturally the question becomes, what does the system do next? If you're new here, I'm Steve, long-term buy and hold growth and dividend investor, nearly 2 decades of experience, real money in SCHD, and I document everything on this channel with real numbers, no hype. Let's talk about Chevron specifically because it illustrates the tension perfectly. Chevron is one of SCHD's largest energy holdings. It has 37 consecutive years of dividend growth. It just hit a fresh 1-year high this week after Bank of America raised its price target to $206. The stock is up nearly 21% year to date. And here's something important. Chevron's dividend is actually very well protected. Their break-even on dividends and capital expenditures is below $50 per barrel of oil. But here's the tension. When a stock's price runs up 21% in 2 months, its dividend yield compresses significantly. A lower yield means a lower score on SCHD's methodology. The index scores every eligible stock on 4 hard metrics: free cash flow to debt, return on equity, indicated yield, and 5-year dividend growth rate. The top 100 names make the portfolio. No exceptions, no discretion, no fund manager overriding the system. Strong price appreciation is actually a liability in this index, not an asset. Chevron may survive the Reconstitution given the strength of its fundamentals, but it will be close, and energy names with weaker scores won't be so lucky. This is the mechanical reality of how SCHD actually works. So let's address the obvious concern directly. Energy is surging. SCHD is about to reduce energy exposure. Doesn't that mean the fund is selling winners at exactly the wrong time? On the surface, yes, that's exactly what it looks like, and I understand why it bothers people. But here's the reframe. This is a feature and not a bug. SCHD loaded up on energy in 2025 when nobody wanted it. It captured the full run, and now the methodology is telling it to rotate out. That is disciplined rules-based value investing doing exactly what it was designed to do. The investors frustrated by this are essentially asking SCHD to chase performance, to hold winners longer than the rules say, to become something it was never designed to do. This reconstitution process is exactly why SCHD has delivered over 10% annualized dividend growth over the last decade. Every time someone complains about a reconstitution, they are essentially complaining about the thing that makes SCHD work. Let's talk about what the projections are actually showing. And I want to be clear about something important. Everything I'm about to share is based on analyst projections and simulations using SCHD's publicly available methodology. These are educated guesses, not confirmed changes. The actual reconstitution results won't be known until March 23rd. With that disclaimer in place, here's what we expect. Energy exposure is expected to drop from around 20% down to roughly 12%, nearly cutting it in half. Financials are projected to receive a meaningful boost. Healthcare is expected to grow as well, with names like AbbVie and Merck potentially expanding their positions. These projections are grounded in SCHD's actual rules, not speculation about market conditions or anyone's personal opinion. The methodology scores every eligible stock and takes the top 100. That rules-based process is what makes these projections reasonably reliable, even if the final results may surprise us. The rotation into financials and healthcare we just talked about could actually be very well timed. These are sectors that have lagged in 2026 and now offer more compelling dividend growth metrics. Healthcare in particular is one of the most defensive dividend reliable sectors in the market, and the possible incoming names have free strong cash flow and long dividend histories. The 2026 reconstitution could play out with SCHD selling energy while it's high and buying healthcare and financials while they're down. not a bad investment strategy. Here's the bottom line. If you own SCHD because you believe in the long-term compounding power of quality dividend growth investing, this reconstitution changes nothing about your thesis. If you want to maximize energy exposure specifically, SCHD was never the right vehicle for that. Buy Chevron directly and own it on your own terms. I own SCHD. I've owned it for years as part of my 4-fund portfolio alongside VU, QQQM, and my individual stock holdings. And I'm not changing anything because of this reconstitution. The energy reduction is going to sting a little if oil keeps pushing higher. I'm not pretending otherwise, but I didn't buy SCHD for its energy exposure. I bought it for its rules-based discipline, its dividend growth track record, and its ability to generate growing income regardless of what any single sector does in any given year. The investors who will get hurt here are the ones who piled into SCHD specifically because of the energy-heavy 2025 portfolio and are now surprised that the methodology is doing exactly what it has always done. Own it for what it is, not for what you wish it would do. March 23rd is coming fast, and the honest truth is nobody knows exactly what the reconstitution will look like until it happens. That's why I'll be back the moment the results drop with a full breakdown of every change and what it means for your dividend income going forward. If this video helped you think more clearly about what you own and why, hit the like button. It helps more people find this content when they need it most. And also consider subscribing so you don't miss the reconstitution results video. And drop a comment below right now. Are you worried about this reconstitution or completely unbothered? I read every single one. If you want my SCHD one-page fact sheet resource, check out my Patreon. Link is in the video description, and you can download it completely for free. You don't even have to sign up for the Patreon. And if you're not sure what to watch next, check out this video right here. If you want to see how many shares of SCHD you need to own to replace a full-time income. Take care, and I will see you in the next one.